What's up, everyone? It's Connor Webb with Envoy Mortgage. I'm here with Sharana with the Asivido team at Keller Williams. We're going to talk today about the 2026 real estate market, kind of what we're seeing, what we're expecting heading into this new year. So I guess starting off, we've seen rates trend downward over this past year and a half from about 7.5%. Now we're in the low sixes, somewhere around 6.1 currently, give or take on your situation. But that's leading obviously to higher demand. More buyers are out there looking to get in the market buy their first home, or even now move up buyers, potentially people that were at a 3% rate now looking to sell their home and move into another property. So I guess let's start off with, this last fall, heading into the winter, now in the spring, what shifts are you seeing in the market?
I feel like for the last 2 years, or just right after COVID, there's always just been this like hopeful mentality, and we've heard it 100 times. The rates are going to come down, and I'm going to ask for the same price that my house was back then, plus plus. And I think everyone's finally coming to the reality that this is just what it is, and hallelujah, because the faster we all get to that place, the faster we can plan for the future. If we're all sitting here just hoping for something that will never be, we're all just kind of stagnating with our equity, we're stagnating with market movement, we're not growing with what is the reality of the market. So one, as a realtor, what I've seen is the people who come back and be like, all right, I guess I'm ready to buy. I should have bought that house that I wanted 6 months ago that is now not on the market because someone else had that foresight. The other thing we're seeing is that people are thinking, oh, I'm going to wait till spring. There's going to be more houses on the market. I don't think it's so much that there's more houses on the market, more than houses have just had more days on market because of the mentality of buyers in the last year. And so that's shifting, and people are kind of taking houses off the market and rethinking their strategy. We all know the rules with the RMLS kind of state that you can't just refresh days on market. You have to kind of pull it off the market, do something a little different, or switch realtors. But people are rethinking their strategies, and that's making things move a little better, at least seeing right now, January 2026. What about you with lending?
So I guess first off, to clarify, if someone wants to refresh their listing, do they have to take it off for a certain amount of days?
So
Or they have to completely get a new realtor, you said?
you have to, so there's a couple ways. Your listing either expires and then you take it off and then you change the photos and whatever, or you change realtors, or you could take it off for essentially a week.
Okay.
But you'd have to completely take it off. It would have to have it expired. You can't just like re-upload a new listing. It would have the same lot number and all of that. So
Gotcha.
the MLS is a little strict with that than they used to be. So I would be careful. But I think safe to say, if you're taking it off the market, people are refreshing and browsing through Zillow just like everyone else. They'll know that it's your house. So be smart about that. Don't just take it off for the sake of refreshing the days on market. Take it off, ask yourself, or discuss with your realtor, am I pricing this right? Recheck the comps, because comps change. People who are pricing their houses and they've been on market for 6 months, a lot of houses have gone on and off the market in those 6 months. Rethink that and look at your photos. What are other houses in my area doing that's working for them? And a good realtor, even if they don't have a team, they would also probably discuss with other realtors and get opinions. So I think taking your house off the market may seem like I'm going to lose days on market, but in the long run, it could really help the perception of your home as the buyer scrolls through Zillow endlessly and sees the same listing over and over again. So
That's speaking as a listing agent. Now, like thinking of as a buyer's agent on the other side, if a buyer were to see that property is sitting for longer, that kind of gives them some leverage, right?
Yeah.
To where you could ask for, or offer a lower sales price, or you could maybe get some seller concessions out of it. I guess looking at it from a buyer side, what strategy do you have when looking at days on the market and inventory and all that?
Well, I feel like a good realtor is like if you're a listing agent. So I like to think I'm a bit of both. I feel like I've had a lot of good success on the listing side, strategizing with clients who have money to modify and ones who don't have money to modify. And as the buyer's agent who's trying to be cutthroat with negotiating, here's the thing. If you've been on the market for 6 months and maybe you've gotten an offer, maybe you've like the inspection is where it falls off. Maybe you realize that like I'm pricing it this much because I'm giving this much gap for negotiation. At the end of the day, when you take it off the market as a buyer walking in, yes, days on market really do make you feel like you have a bigger bargaining chip. But on the seller side, how you can help bridge that gap, it comes down to this. When you redo your comps, going back on the market, or when you refresh your comps, even not taking it off. So let me rephrase that. You don't have to take your house off the market to check comps and adjust your strategy. You can do that and use that as your bargaining chip during negotiations. A lot of the time, it's not just the buyer that you have to combat negotiations with, concessions with, it's also the appraiser. The appraiser isn't always going to come in where you and your buyer think the house is worth. And sometimes having that ready to be able to justify the price, to be able to justify the differences between their comparison and yours, is also just a good thing your realtor should have on hand, like kind of be 5 steps ahead of you. And as the buyer agent, you can also do your homework. You can also be the person who has the comps ready to justify the negotiation. Especially right now, not every house has a bunch of competition, but the competition is your seller. The competition is whether the seller wants to like release the house
If
to
they
you
need
for
to
that price.
net a certain amount.
Exactly. And having that conversation can get frustrating and personal and make people not want to work with each other because they're like, well, I'm already giving them this. Why should I cooperate during the second negotiation? Well, at the end of the day, what's the goal? Do you want to sell your house, and for how much? How much do you want this house? Where's the gap?
Yeah.
Did that make sense?
Yeah.
Okay, cool.
And now that rates are coming down, like that buyer potentially could have a slightly higher sales price and have the same monthly payment because rates are lower now. So it's that could kind of work in both favors.
Yeah. I feel like a lot of people, I come across this in open houses. Like, I feel like open houses are great. Not because every single time is a knockout and I get like 10 buyers, but that would be amazing. But a lot of the time it's a great Q&A with buyers.
Yeah.
They may have another agent, but you can always be a resource where one day they also open their eyes and realize their agent isn't being enough of a resource. Same with lenders. I think having a lender at your open house, you may have a buyer that comes in that already has an agent and a lender, but I think in this market, there's everyone and their grandmother is an agent now. And either you want someone who can just sign your paperwork or someone who can strategize how to maximize what you get out of every transaction. And that's also from understanding kind of a little bit of what the lenders can offer, the concessions, the way refinances and being able to cash out after your refinance and all kinds of little things that you can help them plan in the long run with. Hey, if your house stays longer on the market, this is how much you're going to lose versus if you just came down this much and saved all of us a little bit of pain. So yeah, I think buyers and sellers will benefit a lot from asking the right questions.
Right.
What about you, Connor? How are you feeling like for the lending world now that people are kind of seeing the rates be where they are? What does that change for your business, or how is that?
I feel like it's going to be a really strong 2026 just across the board because, like I mentioned, a year ago, we're talking rates in the mid 7s, give or take. Upper 7s was the high point, or like closer to 8%. And so just the relief from 1% or higher or more of a rate drop has a significant difference to their monthly payments. And now that inventory is higher, prices have settled a little bit to where now prices are slightly lower. Monthly payments are quite a bit lower. People can qualify for more. Those people that were priced out of the market now potentially could buy their first home. Also, some of those people that, like I mentioned earlier, were in a 3% rate, it might convince them to be okay to move now because the rates are at 6 instead of 7.5. But I think it's just going to be much busier in 2026. Like we've had a couple slow years because rates were just higher. And so I feel like the increased inventory combined with just where things are at, more buyers are going to be out there. I think it's going to be a great year.
I feel like, so just as someone who, I feel like everyone's good at what they do. So as a realtor, I know a little bit, but I'm obviously not the lender. But you're someone who owns your house. You've had it for let's say you've had it for 5 years, since 20. Now. There we go.
Yep.
You've had, and the median, by the way, people in Washington, at least in Vancouver-ish area, they I think it's 7 years. Every 7 years, they're kind of thinking of moving.
Yeah.
When someone has a rate at 3 something, what is your main argument for why? Hey, I know it's at 6 something now, but
well, then I tell them hey, do you want to keep it as a rental? Because, for example, my wife and I, we're going to keep our house long-term as a rental because with the lower rate, lower monthly payment, you're going to be able to cash flow much easier. Then you could either look at the equity that you currently have, because if you've owned the property for 5 years, especially in this area, you probably have a decent amount of equity. So you could look at a HELOC. You could look out, you probably don't want to do a cash out refinance because that would jump your rate to where current market rates are at. But potentially a HELOC to pull out those funds. You could look at a 401k loan or other sources to get a larger down payment for your next purchase. So that's one, option that I
And I'm
look
going to
at.
pause you. In the interest of people who like are first-time buyers, what's a HELOC?
Yeah, so a HELOC is a home equity line of credit. And so in general, with a cash out refinance and also with the HELOC, we can go up to 80% of the value of your property for your first mortgage and then also the HELOC or the second mortgage combined. There are programs to where you can go up to potentially like 90% for a HELOC. So we could look at those options. But essentially a HELOC is like a credit card on your property. So it's going to be, you could, let's say you have a $100,000 limit on your HELOC. You could pull out as much of that as you'd like. You could pay it off as often as you'd like. And there's going to be a draw period of 3 to 5 years. Some are longer. But then once you get past the draw period, it'll turn into the repayment period.
Right.
So if there is still a balance on it, then it'll turn into an amortized payment over a certain amount of time. And so that just offers a lot of flexibility. And even if you're not planning to use it, every property that I get, investment property or primary, I'm going to have a HELOC on it because that could tap into the equity. And like I said, you don't have to use it, but it's there if you need to use it or if you want to use it.
And it's there for like also like working on the current home you currently have.
Exactly.
Like my husband and I, we do a lot of our work ourselves because we can. And there's a lot of you out there. It's a very Northwest thing to
I
be able
can't even put up a picture frame.
There we go.
I just
And here I
RV.
am taking down chimneys and putting up support beams.
Wow.
But the property brothers totally ruined that for us. We all think we can just smash a wall down and nothing's
Yeah.
going to happen. But
Open concept.
exactly, with a sledgehammer. Well, on to Connor's point is that a HELOC, which there'll be a whole other video for this, I'm sure, at some point.
Yeah.
But that is also a way for you to build equity on your current home, maybe fix it up to a place where you can rent it.
Yep.
And then afford your next home.
Exactly.
So, but yeah, sorry, I kind of interrupted you.
And we can use 75% of the rents from your departure residence's rental amount to add to your qualifying income for your next purchase. So if we get a signed lease agreement from a tenant that's going to be renting out the property that you're leaving, we can use 75% of that number to help you qualify for your next purchase. So that's definitely something that I've been given to, buyers that are looking to move up. Maybe not selling because they want to keep that rate.
Yeah.
But it offers an opportunity to be able to help them buy the next home.
And the thing is, that's talking about the person who already owns one home. So now
Right.
we're talking, so that was just kind of education for you first-time home buyers. But for the first-time home buyer now,
Yeah.
currently, so we're looking at, I think...
So right now, like all of my buyers, I'm telling them to ask for seller credits
Got it. Okay.
because,
What are they using it for? Like, give us some
yeah,
example.
because the minimum down payment in general, let's say you have above 720 credit score, you're going with a conventional loan, first-time home buyer, you can come in with a 3% down payment. So 3% down, the seller can cover all of the remaining costs. So the only thing that the buyer has to come in with is the down payment. The seller can cover all of the closing costs, all of the prepaid property taxes, insurance, and interest. If they get a large enough seller credit, they could look at an interest rate buy down to buy the rate down permanently, or also short-term buy downs make a lot of sense right now too. So there's a lot of
You're
different.
asking for seller credit, but are they working it into the loan amount, or are they like...
In general, well, I defer that up to the realtor because it's like if there's multiple offers at a 450 sales price, then maybe offer 460 with the $10,000 seller credit. But if it's been sitting for a while, then 450 with the 10,000, or I leave the negotiating up to the realtor to do that.
And to that point, and the reason I kind of probed that question was that a lot of people, that the whole concession topic can come from both ends.
Yeah.
There's either your lender who if you have
I always say to just have that conversation with the realtor. It's like, hey, just ask them about a $10,000 seller credit, what that might look like on this property.
And I think that's such a good point because, like, Connor and I'd like to think we have a good relationship.
Yeah.
But if we when we work on a deal together, my first call would be to Connor and be like, what does this buyer need? What can I do to make the gap, or at least the payments, like, easier for them? What are the costs that will come into helping us close? We're coming back to the conversation of, like, how's this sitting? What is your bargaining tool? A bargaining tool your realtor could use is if a house has been sitting and everyone's trying to bridge the gap a little, find a way where concessions can be roped into it in a win-win way. So that could be like buying down the rate, but the seller still gets the price they want, but they're kind of offering a concession. Some of it is an ego thing. Some people actually do want to sell their house for a certain price because it affects the rest of the neighborhood, its perception. But some people are like, I just need to get out of here, and they're willing to do that. So have that conversation, realtor to realtor, seller buyer realtor, and lender to realtor. Because it's like the marriage of everyone's priorities.
And just for example, this is a current scenario of someone that I'm helping right now. But like, there's two options. One is he could have come in with a larger down payment. But the second option, which is what we're doing, is he's paying off a car loan, which had like an $800 a month monthly payment for like $10,000 is the loan balance. And instead, he's going to come in with 3% down instead of like 5%. And so he's able to get rid of that car payment with some of the funds that he had, get into a home at 3%, get a $10,000 seller credit, take care of all of the all of the closing costs and prepaids. He's getting into his house with just the 3% down payment, the car loan's off, so now he feels like he's in a better spot overall.
That's
instead of just having
work with someone who understands all of that too.
Yeah, and that's the whole refinance stuff. That's where it's not just about what your current rate is. It's like, okay, do you have $20,000 in credit card debt? That's at 25% interest that we need to consolidate too. Because even if you are taking a higher rate, higher monthly payment on your mortgage, if you're getting rid of the credit card debt, then you're in a much better situation overall.
Like,
so
give us an example how that directly
pieces.
affects that. So he gets rid of the credit card debt. What immediately changes?
Well, like, for example, the minimum monthly payment on a credit card could be $500,000, whatever, if your balance is high. But then if your monthly mortgage payment is going up a few $100 a month or something, it obviously varies depending on the situation, but there's a lot of situations to where it makes sense to consolidate, to use some of your home equity to be able to put yourself in a better kind of reset the rest of your financial picture.
So can you use your HELOC to pay your credit card debt?
Yeah, you could. HELOC interest rates are going to be higher than standard fixed rate mortgages. Like, for example, as I mentioned, mortgage rates right now are in the low sixes. A HELOC is going to be somewhere around 10%, give or take, but that's half of what a credit card would be at.
Yes, exactly. Credit card is the death. Don't do it.
So like I say, HELOC is a credit card on your home. It's the same concept, but rates are going to be much lower on a HELOC than they would be on a credit card even. Yeah.
Fair. So I guess let's circle back to this whole buying a house right now. We're looking at median home prices in different areas. So we're just talking about Washington right now. So we're looking at
This is Clark County, Washington.
Clark County, by the way. So across the board, 675 just generally in Southwest Washington, but 530 in Battleground, 530 in Vancouver itself. Camas is a little higher because Camas with school district, everyone wants to live in Camas. And in Ridgefield, 670. So some of them are kind of a little above the first-time home buyer rates. And actually, it's funny.
But that's just the median. You can always find homes.
Yeah, you can always find homes lower than that. I guess my thing is that everyone's feeling like everyone's moving up from Portland, everyone's moving in from California. What are you feeling about, when people are taking home loans and they're with the first-time home buyer, they are having maybe some unrealistic expectations on what is considered the first-time home buyer price? Because homes are feeling less affordable. In your experience with the first-time home buyer, what should they focus on in terms of affordability? How should they focus on what should their first house be like? What in terms of their equity? What is without over?
It's completely subjective because obviously someone's situation, if they're making good money, if they're fresh out of college, they have a 6-figure salary, they're single, whatever, they have low expenses, then they might be comfortable doing something else. But if they're a family, if they have higher expenses, obviously kids and other stuff, they have a lower budget to work with, maybe lower income, and we have to work things around and look at those lower price points. But yeah, it just really depends on someone's situation.
What is kind of the average first-time home buyer like when you're qualifying? What have you been seeing?
Well, to get into the market, really at this point, you have to be above 400,000.
Okay.
So we could say that. It'd be extremely rare to see something in the 300s, especially in Clark County. And if they are looking in those lower price points, I would always say hey, would you be open to maybe going up I-5 a little bit to Cowlitz County, Longview, Kelso, because there definitely could be deals found up there, but it might be a bit more of a commute. And so it's just a big picture conversation of what are your overall goals? What realistically do you want your monthly payment to be at? Because I'm not going to have you out shopping in a price point that you're going to be uncomfortable with. It's
and to that note, for sure, it's we ask each other these questions because I kind of want to probe a topic of being realistic about what you can afford. Right. A lot of people come to a realtor and they want this laundry list of MTV Cribs houses, and you're but I
want an elevator in my house.
Yeah, A lot of people also switch realtors because they think their realtor is not willing to shop with them yet
Yeah.
because they haven't fully qualified. But we're just saving all of you a little bit of heartache between you hating your lender because they didn't give you
Yeah.
the number you wanted.
And this goes back to like the deal that we're closing tomorrow with
Mm-hmm.
one of your team members, is that like at the very beginning, I was like, here's your max price point. And she was like, I want to look up here. I was like, no, you're
Stay
right here.
here.
And now we're closing right here. And she's like, barely qualifying.
Yeah.
We're barely getting there because like if you would have taken my advice up front, we'd be in a better situation.
And
We
what do
would've
you think
closed.
like made her think she could? And I don't mean that she was wrong. Maybe they didn't know what they didn't know. But in
Well,
your
'cause-
opinion, what made her think she could qualify for that?
Because, I mean,
She just wanted
status.
Okay.
And, you know, she does well in her business. But when it comes down to qualifying and realistically what that looks like in a financial, it was a very unique situation, I'll say.
Okay.
But yeah, it's like realistic. It's just kind of trying to keep her expectations realistic.
Right.
Based on what she could actually get for financing.
Yeah. And I think also it's just kind of a little bit of like a respect thing. Like you want to be in a place where everyone's time is valuable. Everyone wants to win. It really doesn't serve us as well to look at houses you can't afford, and it doesn't serve you. We all just start getting, like, without lack of a better word, a little resentful to the situation. Because I had an experience where I showed someone 15 houses because they were I wanted to do them a little bit of a favor. They were not approved yet, but I didn't want to say no to them, and it ended up being half what they could actually afford. And they
wasted your time. They wasted their time.
Exactly. I have a 2.5-year-old. You think I'm wasting time? He has a baby.
Yeah.
But also, it's like I think it comes down to like then people get fully discouraged and then don't buy anything, and that's also not the greatest attitude to have. So I think building the right team in your corner that's not afraid to be honest with you. We take a lot of like crap all day from people telling us we don't know what we're doing and like I want this and I want that, and everyone wants what they want, but at the end of the day, if you're not being realistic, you're just going to end up retreating completely or being told that your baby's ugly, which no one wants to be told, so, basically. So just kind of circling back to inventory. So we went to the economic forecast that was organized by Chicago Fidelity. Am I allowed to say things like that? I think
Sure.
I'm allowed to say things like that.
Let's go for it.
Basically, there was this whole thing about how there's more new construction than ever since 2009. And that's also another interesting topic because builders need to sell their homes, or every day it's on the market, there's holding costs. Like most of them are building model homes, and then everything else is kind of like when someone buys it, then we'll build the next one. But regardless, that whole subdivision is mapped out for them, which in a way is also still a huge bargaining chip because there are more new construction homes on the market than ever. And a lot of them are just like every other resale home. Days on markets are just upticking. So I think we were talking about how builders are more inclined to give a concession.
Yeah,
right?
and because it's like if you're a buyer going into it, it's like, okay, well, this has been sitting forever and this neighborhood is vacant, basically. It's like, okay, should I offer a much lower sales price or should I because builders have massive builder credits that they're willing to give right now to get rid of inventory. And can you walk us through why they would be more inclined to offer a credit than reduce sales price?
To give so at the end of the day, a builder is marketing a product. Like that is just as simple. It's more nuanced than just a resale home because they didn't, again, going back to telling someone their baby's ugly, like they didn't build that house. When you're selling a house to someone else, you're selling them what the house already is. Ooh, that English was amazing. You're selling them what the house is. And actually this will be something we can cover in a little bit, but like settling cracks, and there are things in an inspection where you're like, that's not a red flag. But when a builder sells a new construction, they're selling the product as if it's already done and beautiful and as is. And that's a reflection on the rest of their product that is to come. If their first home or model home or spec home doesn't sell for what they marketed it as and kind of sets the tone for the rest of it.
Right.
So more likely, and I come back to that ego topic we brought up earlier. It's same with sellers. It's like, it's an ego thing in a little way because you need to sell your home for a certain price so people believe in the build and people believe in the product. So giving a concession allows them to keep, let's say, 1.5 million, keep it there and be like, we sold the first home for 1.5 million. Here's the rest of the neighborhood versus we had to come down on price. And then everyone's like, well, if they got to come down on price, can we do that with ours?
Yeah.
And what else can we cut costs with? How desperate are the builders? Everything's taking longer. Materials are taking longer. Permitting's taking longer. So
The costs to build are high in the state in general
exactly.
also.
Everything is just costing more. And so it's also a battle of like, we have to keep this project going, but we cannot lose any more money on it aside from just the holding costs, which is inevitable. So yeah, I think that's a huge reason why concessions are much more desirable to a builder. And if you're not sure how that works, once again, defer to your realtor. They usually would have a good relationship with either the other realtor or be able to have more access to the builder and being able to understand where those costs can come from, and help you get to your price and get you in new construction. Because new construction is great. They actually are across the board, in all kinds of price points. I've seen new construction in the 400s. I've seen new construction in the 1 point something millions, depending on the neighborhood. There is new construction for everyone. It just comes down to how customizable is the build and how much are you willing to tack on. But have that conversation.
How big are the lots? There's a
Yeah,
lot of variables.
exactly. I mean, if you look at new construction in Ridgefield right now, we're looking at a subdivision it's called by Summer Place Homes in Highlands at near Whipple Creek. Those homes start at like a 1.2, but then you still have other ones when you go further
The
north.
neighborhood right next to it even is
Yeah.
like the small,
The smaller
townhome type
homes,
things.
and they're not in the millions, but that's why I mean, like even in Ridgefield, you kind of can get something for everyone in the new construction sector, as you may call it. But anyway, how do new construction, like, is there a difference in getting approved for a resale versus new construction? Like, do you see, like, because I know some builders have preferred lenders.
Right.
Why do they do that?
Well, I mean, if a builder also has a lender, then they're making money on two sides of it. So
Okay.
they can afford to offer like, hey, I'm going to give you a 4% rate because we'll make money or take a slight loss on the mortgage up front. But if you hold that mortgage forever, then we'll make money on that.
Okay.
While at the same time, if we give you a seller credit or a incentive on the builder side, we'll make money on the sale. So it's like because
Wait, is this you as the lender, or sorry, say that again.
if the builder also has an in-house lender, like I'm not going to say a name of a builder and a lender,
don't.
but like if the builder also is lending the money, then they're making money on both sides.
Got it.
Versus like if they have a preferred lender, then we should be able to compete with them because it's like, hey, offer, but say, can I get the credit with my own lender? Some builders are more, lenient than others. They're just trying to move inventory. So like, okay, if you want to bring your own lender, fine, and do it that way. But yeah. So does that make sense? Or do you have any questions on?
I guess as part of that is like part two is, and this is just for people who've never bought a new construction before. When you buy a home that has not got a lot
Yep.
that doesn't have a home on it yet, you're valuing like the base price, whether it be the lot and
Yeah.
then that blueprint.
The biggest variable is property taxes.
Got it.
Because that piece of dirt if you look at the taxes online, it's going to say like $500 in taxes because it was just the value of the dirt. And so we have to get a verification from the county. And so the escrow and title company is the one that will reach out to the county to get a verification on what the actual property taxes will be. In general, when I'm pre-approving someone for new construction, we do 125%. So like, for example, on the standard property, I do about 1% of the sales price as the annual tax amount.
Okay.
And then I break that down into monthly, and that's how I assume what the property taxes are.
Okay.
So with new construction, I do 125%.
Okay.
So it's like 125% of the value is going to be 1% of that number is going to be what I value the taxes at, just to overestimate in case property taxes were higher. Because you never know, and you don't want that to bite you in the butt. So.
And let's say you buy a house, and like, okay, the lot's $250,000, and then the blueprint or whatever model you decide to buy makes it up to 1.2, and then so you do qualify for the 1.2.
Yep.
Then what happens if you decide to get really lofty with your customization dreams? What happens to that gap of extra money that you then need? What do people normally do in that situation?
Well, yeah, we would pre-approve you based on the final value.
So
if
what
you're
if you
planning to
didn't
do
know
upgrades and everything,
Right.
then we're going to have to re-qualify you and be like, okay, yeah, you still qualify for that price
So like
point.
you ran out of money, and then you come back to Connor and be like, I need this much more because my cost. How does, like, you know what I mean? When does that
So
conversation
you're talking
happen?
about like an actual construction loan?
Yeah. So
Yeah.
so that's a construction loan.
So there's construction loan versus basically buying it as a finished product.
Right.
So there's two different ways to do it. Like one is in most cases in this area, if a builder is building out a neighborhood, then they'll do it to where they carry the financing through the process. And then so you as the buyer are getting pre-approved and getting under contract. It's assuming a completed sales price, but you don't actually have to get a construction loan yourself. You don't get financing at all until the home is done.
Okay.
Now, if you're buying your own piece of land and then you're looking to build your own home on that piece of land out in the sticks or whatever, then that's where you would carry your own construction loan.
Got it.
Which is a totally different process. And there's the draw periods and all that, which is complex. But standard in town is like you're getting pre-approved and you're buying it as if it's an already done home.
Right. So this is the difference between buying like a home in a subdivision that has
Right.
plans and buying, like you said,
A piece of dirt and then building yourself.
Exactly.
Yep.
And I think that's kind of the part people don't understand. That's two different loans. So talking to your lender will also guide you through that. And it doesn't mean you can't own new construction. It just means like what kind of loan, and are those different rates? They are different rates.
They would be, in general, in the same ballpark, you could say. Construction loans might be, in general, when you're building your own home, it's going to be more costly than you probably think up front. So that's just another piece of it is there's a lot of people that go into the process initially of the pre-approval of like, yeah, I want to build my own home. It's like, okay, well, talk with your realtor. And also, once you actually start to get some of these plans done, and if there's no utilities on the property yet, there's so many more
that
costs.
adds so much.
There's so many additional costs that people don't think about until they get too deep into the process. So.
Right. As a realtor, everyone's talking about how Vancouver's getting crowded. There's so much going on. It's a supply and demand thing. If people want to move here, your house, it's only going to benefit your home. It's not going to always be pleasant because it just means that tree wasn't there, was there before, isn't there anymore. But at the same time, I think having a positive attitude on the fact that your equity builds with your town. If people want to live here and are moving up from Portland and are moving up from California, it just means Vancouver is becoming more desirable. It doesn't necessarily always look pretty and doesn't necessarily always feel pretty, but at the same time, it just means that you're doing the right move by owning real estate, and real estate is still the best investment you could make for your long term, for your family, for your children, for your bank account. What do you think, Connor?
Yeah, and in general, the Pacific Northwest has a high demand. Like compared to the rest of the country, you look at the national averages of what's happening with sales prices, the PNW is going to be on the higher end. And, I made a video on it the other week to where even the fact that Washington State has no income tax versus Oregon has income tax. That's one of the reasons why people are moving from Oregon to Washington, because as you mentioned, like there's no more dirt to build on in Vancouver. It's moving up I-5. That's why Ridgefield is blowing up right now. But people are moving to Washington, specifically in Clark County, for the fact that it's the PNW, but then also the tax benefits, other reasons too. It's like you can go to Portland if you want to, but you don't have to live in Portland.
Yeah.
So it's definitely a spot that we would recommend to buy. That's why we live here. That's why we're going to continue to help people buy and sell in this area. So if you have any questions, reach out to one of us. We'll have our contact information in the description below, and we'll see you soon.